I am not an economic doomer, but it is hard to stay optimistic for the short-term future when we see things like inflation staying well above 2%, the stock market having barely moved in 2 months, more tariffs being currently in motion from the Trump administration, and now finally it seems like the average consumer has had enough and is pulling back on spending. So I want to talk about what's going on, how we got here, what the future looks like, and how you can prepare. But first, we gotta talk about the report. U.S. consumer spending posts first drop in almost 2 years. U.S. consumer spending fell for the first time in 2 years in January. And the goods trade deficit widened to a record high as businesses front-loaded imports to avoid tariffs, setting up the economy for weak growth or even a contraction this quarter. While the data from the Commerce Department on Friday has also showed a moderation in annual inflation the past month, prices have showed some stickiness with fairly solid monthly gains. In addition, President Donald Trump's administration is ratcheting up tariffs, which economists would say raise prices as businesses passed on the higher costs of the good imported to the consumers. So we've got a lot of things that are hitting at the same time here, with the big things being that businesses and consumers alike are both afraid of tariffs increasing the prices. And this has caused businesses to import a bunch of extra goods to try and hedge against the fact that the prices will be going up soon. And at the same time, this has caused consumers to actually spend less money because they fear that prices will be going up soon. Reuters talks about it more here. U.S. businesses' activities nearly stalled in February amid mounting fears over tariffs on imports and deep cuts in federal government spending, erase all of the gains notched in the aftermath of President Donald Trump's election victory. The tumble in activity to a 17-month low reported by S&P Global on Friday was the latest in a string of surveys to suggest that businesses and consumers are becoming increasingly rattled by the Trump administration's policies. Now, this is not about politics. This is not a political channel. I'm not making an argument for one party or the other, but there are two things that we have to talk about. The fact is people are worried about, one, inflation and government spending and benefits, because if the government has less money going to the people have less money to spend. And if inflation goes up, then the amount of money that people do have to spend is worth less, so they'll be able to get less stuff for the money that they have. Both of these together mean that your average to low-income consumer has less money to spend on goods and services, so we expect the consumer to start pulling back, which is what we're doing and what we'll look at later. And you could actually argue that that's fine. You could say the government does too many handouts or has spent too much money on benefits, and that money is going to places where it's not being properly utilized, and so this is a way to remedy that. Or you could argue it the other way and say that this is bad since lower income people will have less money to spend. It is a reasonable argument both ways. My point is that as it stands now, people are seeing this in a negative light. They are worried about having less money or the money they have being worth less, and so they are pulling back on spending. And before we get more into the original report, if you like this kind of deep dive into the news, I've tried to post twice a week and I'd love a subscription. Now, back to the original report. Consumer spending, which accounts for more than 2/3 of the U.S. economic activity, dropped 0.2% last month, the Commerce Department's Bureau of Economic Analysis said. That is the first decline since March of 2023 and the biggest decrease in nearly 4 years. It followed an upwardly revised 0.8% increase in December, which was previously reported as a 0.7% advance. Economists polled by Reuters had forecast consumer spending gaining 0.1%. Outliers in prior months were boosted by preemptive buying ahead of tariffs, which were reversed in January. Then we're talking about personal consumption. Unreasonably cold temperatures and snowstorms that engulfed large parts of the country were likely drags on spending, as were wildfires, which scorched much of the Los Angeles area. Spending on goods tumbled 1.2%, led by motor vehicles, recreational goods, household furniture, clothing, and footwear, as well as food and beverages. Service outlays, and this is important, rose 0.3%, lifted by spending on housing and utilities, as well as food services and accommodation. They offset a decline in expenditures by nonprofit institutions, which economists attributed to deep spending cuts in the United States Agency for International Development, which is USAID, and has become very famous here in the last month or so. So basically, all of that, it means that consumer spending is down, despite expectations and predictions that it would continue to go up. And it's down in basically every industry, except notably for ones that involve like food and accommodation. So basically the two things you need to survive, meals and housing. And that's probably because low-income people relied on getting that stuff from charities, and those charities relied on getting funding from the government, which is no longer coming in. And so as a result of that, low-income people have been forced to spend more than they would previously because they were getting it previously from charities. So all this is to say that people are worried about these kinds of things and are pulling back on spending pretty much across the board. And those worries might not be entirely unfounded, especially when you look at some data, with the first of which being the stock market. Now, to be clear, the stock market is not the economy. It represents how people feel about the economy and how people feel about where the economy is going to go, whether it's going to go up or down. But if we go year to date and then look, it is only up 1.46% from January all the way through February. So that's 2 months of people not purchasing into the stock market. So the value of the stock market is not going up. That means that people aren't feeling great. And this is also reflected in February's consumer sentiment report, which has been dropping. You can read about it here. Consumer confidence dropped sharply in February. The Conference Board Consumer Confidence Index declined by 7 points in February to 98.3%. And this number right here just means it's compared to people, how confident they were in 1985. The Present Situation Index, based on consumers' assessment of current business and labor market conditions, fell 3.4% to 136.5. The Expectations Index, based on consumer short-term outlook for income, business, and labor market conditions, dropped 9.3 points to 72.9, which is quite low. For the first time since June of 2024, the Expectations Index was well below the threshold of 80, and that usually signals a recession ahead. The cutoff date for preliminary results was February 19th of 2025. So consumer confidence has actually been pretty shaky since the high inflation period from like 2021. And basically, this report is saying that it's going down again after a brief spike where it went up shortly after the Trump election, because a lot of people were hoping for things like lower taxes, fewer regulations, better stock returns, and just cheaper stuff overall. With the stuff being cheaper and there being less regulations to make it expensive to do things, people thought, well, there's going to be more stuff to buy. It'll cost less, that'll boost the economy, and the stock market will go up. But then it turned out that they might actually get tariffs instead. And this caused people to lose confidence, because suddenly these things will be cheaper so I can spend more money. Started to be, well, maybe things will be more expensive so I'll have less money. So I'm going to stop spending money now and start holding on to it. And that's been causing the economy to remain unchanged over the last couple of months. And this is especially troubling when you scroll down a little bit and you see that the Consumer Confidence Index, or how confident the consumer is about the state of the economy, has been going up for over a decade now. Consumer confidence was low in 2009. Obviously, there was the housing crash, and then it basically went straight up until about 2019 or 2020. For that 10 or 12 year stretch, it was continuing to go up kind of no matter who the party was. We had a Democrat and a Republican president in this time, and the Consumer Confidence Index went up despite that. And now we're seeing basically since then, in about 2020, when things started to go down due to the COVID pandemic and the recession that came because of that, people are really not that confident anymore. And that's despite the fact that we have had presidents of both parties since then. It dropped under the tail end of Trump. It went up a little bit in Biden's time, but then after inflation hit, started to drop again. And it looked like it might go up when Trump was reelected, and people were hopeful that the economy would return to what we saw in the 2016 to 2020 range. But then now, after Trump saying that he might do tariffs, it's starting to go back down again. So it was good for a long time, despite who was in power, and now it's been mediocre to going down for a while, despite who's in power. Now, I said consumers might have good reason to be worried, and here is another reason that is. It is tariffs. Fact sheet. The President Donald Trump imposes tariffs on imports from Canada, Mexico, and China, which is where we get a lot of our imports from. Until the crisis is alleviated, President Donald Trump is implementing a 25% additional tariff on imports from Canada and Mexico, and a 10% additional tariff on imports from China. Energy resources from Canada will have a 10% lower tariff, which is good. We need those energy resources because energy is pretty volatile and also going up. Now, Trump has been toying with the idea of tariffs for a while. It was a campaign trail promise, and then he declared that he was going to do it in like his first 100 days in office, and then he walked it back, but it seems like maybe he's walked back the walk back and might actually be doing tariffs now. And this makes people worried because tariffs just straight up increase prices. And if you increase prices, or you threaten to increase prices, then people will start spending less money. And we actually saw people spending less money in the retail sales report from January, which actually retail sales dropped, which is not great and not what you want to see. Retail sales slumped 0.9% in January, down much more than expected. Consumers sharply curtailed their spending in January, indicating a potential weakening in the economy growth ahead, according to Commerce Department on Friday. Retail sales slipped 0.9% for the month from an upwardly revised 0.7% gain in December, even worse than the Dow Jones estimated for a 0.2% decline. The sales totals were adjusted for seasonality, but not inflation, for a month in which prices rose 0.5%. So basically, people thought that it was going to go down a little, and then it actually went down a pretty significant amount, even when you adjust for seasonality. Excluding autos, prices fell 0.4%, also well off the consensus for the forecast of a 0.3% increase. A control measure that strips out several non-essential categories and figures directly into calculations for gross domestic product fell 0.8% after an upwardly revised increase of 0.8%, with consumer spending making up about 2/3 of all economic economic activity in the US, the sales numbers indicate a potential weakening in growth for the first quarter. So all this data we've talked about right up until this retail sales report from January goes to show two big things. One, people think the economy is now or will soon get bad. And two, because they believe that, they are pulling back on spending. And because they're pulling back on spending, that's causing a chain reaction to make the stock market essentially go down, but for the most part, kind of not change over the last 2 months. Now, whenever we hit times that might become hard economic times, we are not necessarily by the data in them right now, but they may be coming soon, the inevitable question comes up, well, what can I do about it? And really, the advice for what to do in hard economic times is not that much different from good economic times. Live within your means, continue to invest 10 to 20% of your income for retirement, don't take out unnecessary debt, and at least stay mostly, 80% on a budget. The only extra advice that I would add for when economic times look like they might be turning down is maybe have a couple extra months saved up in your emergency fund, especially if you're in an industry that a downturn might cause you to be laid off. So something like software engineers, which are pretty quick to be laid off, or a factory worker. But other than that, there's kind of no stellar advice to help you prepare for this. Good financial habits are the same during good times as they are during bad times. You just need to be responsible with your money insofar as you are able to, and don't panic when things get rough, because really, things like this happen and get rough every few years. So you just gotta be ready for it. Thanks for watching.